Welcome back to The Deep Dive. We're the show that takes a deep dive into complex topics, pulling out the key insights for you.
Glad to be here.
Today, we're wading into some, let's say, interesting waters,
Hmm.
long-term construction contracts and accounting.
Yeah, specifically when things start to go sideways.
Exactly, when those losses pop up. The big question is, how do accountants deal with losses on these multi-year projects? Especially when, maybe it's just a temporary dip.
Or maybe it's a sign the whole thing's going under.
Precisely. How do you account for that uncertainty? But before we really get into the weeds, just a quick reminder for everyone listening. This deep dive is based on material from Farhat lectures.
That's right.
All the content, the examples, the explanations, it's all derived from the great accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe studying for the CPA exam, or you're already a professional, definitely check out the website.
Lots of extra practice questions, videos, support materials there.
Absolutely. It can really help reinforce what we talk about today. And a big thank you to Professor Farhat for providing this valuable material.
Definitely.
Okay, so to really get our heads around these loss scenarios, you absolutely need to understand the percentage of completion method. That's sort of our framework here.
It is. And tied closely to that is the construction and process account, the CIP account.
Right, the CIP, that's like the project's running tab on the balance sheet, isn't it? Costs, profits.
Exactly. Costs incurred, profits recognized, it all accumulates there. And critically, that's where these losses are going to make their mark.
Okay. And you mentioned there are really two distinct kinds of losses we need to pull apart.
That's right. They look different, and they're treated very differently in the books. It's not a one-size-fits-all thing at all.
Okay, let's break that down. What's the first type?
So the first type is, let's say, a loss you incur in the current period, but, and this is key on a contract that you still expect to be profitable overall.
Okay, like a temporary setback.
Exactly. Imagine a 4-year project. Years 1, 2, and 4 look profitable. But year 3, something unexpected happens.
Like what?
Could be anything, really. Maybe material costs spike unexpectedly because of some global event, or there's a labor strike that drags on.
Right.
So you end up with a loss for that year, year 3. It's a rough patch. But when you step back and look at the whole 4-year picture, the project is still projected to make money overall.
Okay, so a bad year but not a doomed project. What's the second type then?
The second type is, well, much more serious. This is a loss on a contract where you now project it's going to be unprofitable overall. The whole venture is underwater.
Ah.
So using that same 4-year example, maybe in year 3, the problem isn't just a temporary spike. Maybe it's a fundamental design flaw they discover, or a massive cost overrun they just can't recover from.
Something systemic.
Right. It's so significant that even if they make some profit in year 4, it won't be nearly enough to offset the losses. The entire project, start to finish, is now expected to lose money. That changes everything.
So the absolute key distinction for you listening is whether the overall project is still expected to make money or not. That's the fork in the road for accounting treatment.
Precisely.
But, how clear-cut is that in reality? How does a company decide, okay, this is just a blip versus, uh-oh, this whole thing is sunk? Is there some subjectivity there?
Oh, absolutely. That's a great point. It's not always black and white. Management have to constantly re-estimate total project costs, total projected revenues.
The forecasting is key.
Huge. They're looking at current spending, future risks, market conditions. There's definitely judgment involved. That's why things like strong internal controls and, frankly, clear communication within the company are so vital.
And what signals a blip versus a fundamental problem?
Well, usually a temporary blip, like that material price spike, has a specific identifiable cause you expect to resolve itself or be contained. But when a project becomes overall unprofitable, it often points to something deeper. Maybe the initial bid was way too low, or there are ongoing operational issues, or the market itself has changed dramatically. It's a mismatch between the contract price and the total cost reality.
Okay, that distinction is critical. Now, to really see how these loss rules work, it probably helps to first see how a normal, profitable project flows through the books. Can we quickly walk through that baseline?
Yeah, definitely. A quick review of the standard percentage of completion method is essential. Let's set up a basic example. Say we have a contract, total price is $700,000.
Okay, $700K contract price.
Right, so year 1, Let's say costs incurred are $150,000. And at this point, they estimate it'll cost another $450,000 to finish.
So total estimated cost is $150K plus $450K equals $600,000.
Exactly. The project looks profitable overall, right? $700K price versus $600K cost.
Yep, $100 expected profit.
So the percentage complete in year one is costs incurred to date, $150K divided by total estimated costs, $600. That's 25%.
Okay, 25% done.
So we recognize 25% of the revenue. 25% of $700,000 is $175,000.
Revenue for year one, $175K.
And the cost of revenue for year one is just the costs incurred that year, $150,000.
Which gives us
A gross profit for year one of $25,000. 175K, 150K. That goes on the income statement.
straightforward enough. What about year two? Costs usually change, estimates change.
They often do. So let's say in year two, we incur another $300,000 in costs. So costs incurred to date are now $150K from year one, plus $300 for year two, totaling $450,000.
Okay, $450K cumulative cost.
And let's say the estimate to complete is now revised slightly to $181,000. Maybe things got a little more expensive.
So the new total estimated project cost is $450K plus $181K, which is $631,000. Still profitable overall compared to the $700K price.
Right. Still looks good overall.
Yeah.
Now, the percentage complete is based on the new total cost estimate. So $450,000 incurred to date divided by $631,000 total estimated cost. That comes out to about 71%.
Okay, 71% complete now.
So total revenue to date should be 71% of $700,000, which is roughly $499,208.
Right, but we already recognized some revenue last year.
Exactly. We recognized $175,000 in year one. So the revenue recognized this year in year two is the difference. $499,208 minus $175,000 equals $324,208.
Got it. Revenue for year two is $324,208, and the cost.
Cost of revenue for year two is the actual cost incurred in year two, which was $300,000.
Okay, so profit for year two is $324,208 minus $300,000, $24,208.
Correct. Another profitable year.
And year three finishes it up.
Let's say year three completes the project. Costs incurred in year three are that final $181,000. So total costs incurred to date are now $631,000, matching our final estimate. Estimate to complete is 0.
So 100% complete.
Yep. Total revenue should be the full $700,000. We've already recognized $499,208. Is the cost to year three the cost incurred in year three?
$181,000.
Leading to a profit in year three of $19,792.
Exactly. And if you add up the profits from each year, $25,000 plus $24,208 plus $19,792.
That comes out to $69,000, which makes sense because the final cost was $631K and the price was $700. Precisely. That's our profitable baseline. Everything lines up. Revenue, cost, and gross profit hit the income statement each year.
Okay, that baseline is crystal clear. Now, let's throw a wrench in the works. What happens when we hit that bump you talked about, a loss in 1 year, but the project overall is still okay? Let's use our same $700K contract.
All right, scenario 2. Year 1 stays the same. We book that $25,000 profit. No changes there.
Okay, $25K profit in the bank from year 1.
No, year 2, the loss year. Things go wrong. Let's say costs incurred this year are much higher, say $340,000 instead of the $300K in our baseline.
Ouch. Okay, $340K cost this year.
So total costs incurred to date are now $150K. Y1 plus $340K Y2 equals $490,000.
Getting expensive. What's the estimate to complete now?
Let's adjust that slightly too. Say it's now estimated at $182,000 to finish.
So the revised total estimated project cost is $490K plus $182K equals $671,000.
Okay, now here's the crucial check. Is the project still profitable overall?
Well, the contract price is $700 pay. Total estimated cost is $671K. Yes, it still looks like it will make $29,000 profit overall.
Bingo. That's the key insight for this scenario. Despite the bad year, the overall project expectation is still positive.
Okay, so how does the accounting work for year 2 now?
We still calculate percentage complete. Cost to date, $490, divided by total estimated cost, $671K, gives us about 73% complete.
So 73%.
Total revenue to date should be 73% of $700, which is roughly $511,177.
And revenue this year is that total minus the $175K from year 1.
Correct. $511,177 minus $175,000 equals $336,177. That's our revenue for year 2.
Okay, revenue is $336,177. Now the cost.
The cost of revenue for year 2 is the actual cost incurred this year, which was that high $340,000.
Yeah. So revenue, $336,177, cost $323,000.
That means we have a loss for year 2. $336,177 minus $340,000 equals negative $3,823 eventually.
Exactly. That's the crucial distinction for this type of loss. You recognize the loss in the period it occurs.
And what about year 3? Does it just revert back? Pretty much. In year 3, let's say the remaining $181,000 is spent to finish the project. Total costs hit $671K. Project is 100% complete.
Okay.
Total revenue is $700. We've recognized $511,177 so far.
Yeah.
So revenue for year 3 is $700Ks. $511,177 equals $188,823.
And cost for year 3 is the $181,000 spent.
Right. So profit for year 3 is $188,823 minus $181,000, $7,831.
Okay, let's check the total. Year 1 profit, $25K. Year 2 loss, $703,823. Year 3 profit, $771K total cost. It works.
It balances out. The key is you recognize the loss attributable to that specific year's activity when it happens, but you don't touch the previously recognized profit from year 1.
And that $3,823 loss in year 2, how does that hit the balance sheet? Through the CIP account?
Precisely. The journal entry recognizing that loss would effectively reduce the CIP account. It reflects that dip in expected overall value, but the CIP account itself still represents an asset overall because the total project is profitable.
So management sees the hit on the income statement for year 2. Project managers probably get some heat.
Oh, absolutely.
But the project itself isn't deemed a failure yet. Are there incentives then for project managers to maybe smooth those costs out to avoid showing a loss in any single year?
That's always a risk, the temptation to manage earnings or cost recognition. Strong controls and audits are meant to prevent that. But yes, a loss in a current period definitely triggers alarms. Project managers will be under pressure to find efficiencies, control costs, and make sure that overall profitability target, $29K in our example, is still achievable. They have a strong incentive to prevent that blip turning into the next scenario.
Right. The dreaded scenario 3. What happens when it's not just a bad year, but the whole project is going south? This is where that conservatism principle really kicks in, right?
Exactly. This is the big one. Accounting rules take a very firm, very conservative stance here. Let's set it up. Again, year 1 is our standard profitable year. $25,000 profit recognized.
Okay, starting point is the same.
Now, year 2, the year things turn really bad. Costs incurred this year skyrocket. Let's say they hit $420,000.
Wow. Okay, $420K this year.
So total costs incurred to date are $150K, Y1, plus $420K, Y2, it would be $570,000.
And the estimate to complete.
Let's keep that estimate to complete at $181,000 for simplicity.
Okay. So the new total estimated project cost is $571K incurred plus $181K to complete. That's $751,000.
$751,000 total estimated cost. Now compare that to the contract price.
Contract price is only $700,000. Total cost is estimated at $751,000.
Uh-oh. Oh, is right. The entire project is now projected to lose $51,000. $700K, $751K.
Okay, so this is the trigger point. The overall project is unprofitable.
This is the trigger, and here's the massive rule change. When a project is identified as overall unprofitable, you must recognize the entire anticipated loss for the whole project immediately in the current period.
The entire $51,000 loss right now. In year 2. Yes. That's conservatism. You don't wait. You recognize the bad news now.
But wait, we already recognized a $25,000 profit in year 1. How does that factor in? Great question. You have to account for that. The goal is to make the cumulative profit or loss recognized to date equal the total anticipated loss of $51,000. Since we're currently sitting at a $25K profit from year 1, we need to book a loss in year 2 that not only reflects the $51K future loss, but also reverses the $25K prior profit.
So the loss we need to recognize in year 2 is the $51K total anticipated loss plus the $25K profit from year 1 we need to wipe out.
Exactly. $51,000 plus $25,000 equals $76,000. That is the gross loss that must be recognized in year 2.
A $76,000 loss in year 2. That's huge. How do we calculate revenue and cost to get that result?
Okay, revenue recognition still follows the percentage complete logic based on the new numbers. Percentage complete is cost to date, $570K divided by total estimated cost, $751K, which is about 76%.
Okay, 76% complete.
So total revenue to date is 76% of $700, or about $531,292.
For revenue this year, year 2, is $531,292 minus the $175K from year 1. So $356,292.
Correct. Revenue for year 2 is $356,292. Now, we know we need the gross loss for year 2 to be $76,000.
Right.
So the cost of revenue for year 2 becomes a plug figure. It's the number needed to make the math work. If revenue is $356,292 and we need a loss of $76,000, then cost of revenue must be revenue plus the loss, $356,292 plus $76,000 equals $432,292.
Exactly. Cost of revenue booked in year 2 is $432,292. Notice this is not the actual cash cost incurred this year, $420K. It's higher.
Why? Why inflate the cost number?
To force the recognition of that entire $76,000 loss now, it ensures the income statement reflects the full expected negative impact of the project immediately. It's a cumulative adjustment hitting this year's P&L.
Wow, so the expense isn't just this year's activity, it's catching up on the entire project's negative outlook.
That's a perfect way to put it.
So what happens in year 3 then if the project finishes?
In year 3, let's say the final $181K is spent. Total costs hit $751K. Project is 100% complete.
Okay.
Total revenue is $700. Revenue recognized to date was $531,292. So revenue for year 3 is $700. $531,292 is after $168,708.
And the cost for year 3? Cost incurred in year 3 was $181,000. However, remember we already recognized the entire anticipated loss in year 2. So for year 3, we simply recognize revenue equal to the cost. The cost of revenue booked will be $168,708 to match the revenue.
Meaning year 3 shows zero profit or loss.
Correct, because the total project loss of $51K was fully accounted for in year 2. Through that $76K loss recognition, which included reversing the year 1 profit, there's nothing left to recognize in year 3.
That is a drastic difference. Recognizing that huge $76K loss in year 2, that's got to send shockwaves through a company, right? Why do it that way? Why not smooth it out?
It really comes down to that principle of conservatism and transparency. The idea is not to mislead investors, lenders, or other stakeholders by delaying bad news.
So it prevents companies from kind of stringing people along on a failing project.
It's essentially, yes. If a project is truly expected to lose money overall, the financial statements should reflect that reality as soon as it's known. Delaying it would paint an overly optimistic picture.
And how does that huge loss recognition in year 2 affect the balance sheet, the CIP account?
It has a major impact. That $76,000 loss is recorded as a credit to the construction in process CIP account. It drastically reduces the carrying value of that asset on the balance sheet, reflecting the fact that this project is now a liability in terms of future profitability. It clearly signals the impairment.
So seeing a big credit to CIP related to a specific project is a red flag for analysts.
A very big red flag, yes. It tells you management has determined this project will lose money overall.
Does this immediate recognition impact things like, say, a company's ability to get loans or its stock price?
Oh, definitely. It's a gut punch, like you said, but it provides clarity. Lenders seeing this will have a much clearer, albeit worse, picture of the company's immediate financial health and potential future cash drains. It might make borrowing harder or more expensive.
And the stock market?
The market generally dislikes negative surprises, but it dislikes hidden negative surprises even more. While the stock might take a hit when the loss is announced, the transparency is often seen as better in the long run than finding out later the management was masking a problem. It allows the market to reprice the risk accurately.
Okay, so pulling this all together for everyone listening, whether you're starting this, managing projects, or maybe even investing, what's the absolute core takeaway?
The core takeaway is the critical distinction based on overall project profitability. If the project is still expected to be profitable despite a bad year, you only recognize the loss for that year. But the moment you determine the entire project is headed for a loss, conservatism kicks in, and you must recognize that entire anticipated loss immediately, including reversing any prior profits.
Don't delay the bad news.
Don't delay the bad news. It ensures transparency and prevents stakeholders from being misled about the true financial health of these long, complex undertakings.
And it really highlights how crucial accurate forecasting and project monitoring are. You need to know as early as possible if you're heading towards that overall unprofitable state.
Absolutely. It's not just an accounting exercise, it's fundamental project management.
So this isn't just about ticking boxes for GAAP or IFRS. It actually gives analysts and investors a powerful tool. Seeing how a company handles these losses tells you something about their management quality and transparency, right?
Exactly. Are they facing temporary headwinds, or are there deeper issues with estimating, bidding, or execution? The accounting treatment provides clues.
And you mentioned the temptation to maybe manage this, to delay recognizing that big loss. How strong are the safeguards against that?
The accounting standards themselves, GAAP and IFRS, are quite strict. The conservatism principle isn't optional. Auditors play a key role here too, scrutinizing management's estimates and judgments about project profitability. Deliberately delaying the recognition of a known overall loss would be a serious violation.
So while there's judgment in estimating the total cost, once that estimate points to an overall loss, the accounting rule is pretty rigid.
Very rigid. Recognize it now. It promotes discipline and, ultimately, trust in the financial reporting. So maybe something for you to think about is how this immediate loss recognition might change how managers behave. If you know you have to take the full hit immediately, does that make you quicker to maybe cancel a failing project altogether rather than throwing good money after bad?
That's a great point. It removes the incentive to just hope things turn around next year if the numbers already show it's unlikely.
Right. And for investors, how does knowing a company follows this conservative approach affect your confidence in their numbers? Even when they report a big loss like this, does it increase trust in the long run?
Yeah, maybe counterintuitively, taking the pain up front could be seen as a sign of strength or realism.
Could be. Also, think beyond the numbers. What are some non-financial warning signs that might hint a project is turning sour? Perhaps even before the official accounting recognition catches up. Things like major delays, disputes, high staff turnover on the project.
Those qualitative factors, that's really interesting. It connects the accounting back to the real-world operations. This really underscores the importance of robust risk management and planning from the very start of these long projects.
Absolutely. Accurate forecasting, quick reaction to changes, it's all critical.
Well, this has been incredibly insightful. We've seen how accounting grapples with the complexities and uncertainties of long-term projects, especially when things go wrong. It's clear that understanding these nuances is vital for anyone trying to get a true financial picture. Thanks for breaking that down.
My pleasure. It's a complex but crucial